Hey Bowtie Nation, Joseph Hogue here with our third stock comparison video. Steven in our Facebook group suggested a this versus that theme, matching up some of the most popular stocks against each other to see which is the better investment. We've got a great lineup for you this week with some of your favorite stocks, including JP ticker JPM, Bank of America, BAC, Ford, ticker F, General Motors, ticker GM, Realty Income, ticker O, and Simon Property Group, ticker SPG. We're going to look through the analysis on each one for each stock to buy and which one to throw out. I'm going to be using some research and data from Seeking Alpha for the video. If you want to check out more of that analysis, I've set up an exclusive deal for all you out there in the Bowtie Nation. Use the link below to try Seeking Alpha, and if you decide you like it, you'll get a 50% discount on the premium access. That's $120 off the membership and the lowest price you'll find online. In fact, it's lower than the price I paid for premium access when I signed up. But let's get started with our matchups with JP ticker JPM, and Bank of America, ticker BAC. We're going to start with the growth prospects here, the revenue over the last year and forward revenue, as well as the 5-year averages for each. Now, I've detailed why I'm looking at these and how I'm looking at each of these in previous videos. I'll link to in the description below. Here we see that both of these banks have recorded negative revenue over the last year, falling not only as the economy weakens, but also on lower capital markets as well. We do see here that in these 5-year averages, though, JP produced the higher 5-year average for revenue growth at 6.3% versus just 2.5% for Bank of America. Much more important than that revenue growth, for banks, you always want to look at this return on average tangible common shareholders' equity. This is the core to return measure for banks. And you can see here that JP has the clear advantage over the years from 19%, 18%, even 20% return on tangible common shareholders' equity here in the fourth quarter of 2022 versus 17% in 2021 for Bank of America and 15% more recently. So we see here two things. Not only does JP have a clear advantage in that return, in the operational profitability of the bank over Bank of America, but we also see different trends in the two banks. We see that from 2021 to 2022, Bank of America actually dropped in its profitability from 17% to 15%, whereas JP from 21 to 22 earned upwards of 1% or 2% in that return metric. So from 19 to 18 in the third quarter of 2022 to the fourth quarter of 20% return on tangible common shareholders' equity. And one thing we've talked about recently with the banks, very important, is their loan loss reserves. This is the amount of money, the amount of income they take off of their income statement, put it on their balance sheet as kind of a loan loss reserves, kind of a cash account, just in case a recession or the economy gets bad and they have a lot more loan defaults. Okay, this is money that they take out of their income from their income statement. They store it on as a cash reserve, that loan loss reserves on their balance sheet to say that, you know what, we have all these loans that we're collecting on, but if the economy gets really bad, we might not collect on those. So we're going to have a cash account just to protect ourselves from there. Currently, JP has about $19.7 billion set aside in this cash reserves against about $1.13 trillion in loans. So that's about 1.7% of its loan book that is covered with cash in this loan loss reserves account. On the other hand, Bank of America has about $12.63 billion stored away in this loan loss reserves account. That's against $1.039 trillion in loans. So that's about 1.2%. So clearly, JP storing more what-if money away on their cash account to cover any kind of defaults or any kind of a economic recession scenario. Now, what I'm saying here is that if that recession doesn't come, or if it's very moderate and those loan losses, those defaults don't come up like these banks are expecting, they're going to have all these billions of dollars in this cash account that they can then move back into their income statement to surprise upwards on earnings. I think this is going to happen in 2023, in 2024 with all the banks really surprising on the upside with their earnings, but it's going to happen more with the banks that obviously have more set aside, like JP here with its 1.7% of loans covered with this cash account. So we can start seeing that JP has a clear advantage in not only revenue and sales growth, but also profitability against Bank of America. But one thing that does worry me about JP is its build out of a consumer ecosystem that I can share in a chart here. Here in this graphic of recent acquisitions and investments by JP we see a build out of a lot of things really unrelated to that financial space, especially in this loyalty and travel program. JP bought out a loyalty programs reward program. It bought out a travel agency. It's got the Zagat. So it seems JP is trying to build out this whole ecosystem for the consumer where it can cross-sell maybe people from its financial services into consumer services as well. This travel agency, the restaurant review platform, the travel loyalty rewards tech program. And I wonder if it's maybe just a little bit too much, okay? Maybe a little bit too much overreach for JP Morgan. I mean, they have undoubtedly been the leader in banking financial services there. What makes them think that they can take that leadership and apply it to a consumer ecosystem as well? Kind of scares me that they might be shifting their focus a little bit too much here. Now, bringing it into valuation, of course, with the banks, the ratio you always want to use is this price to book ratio, this middle one, the price to book trailing 12 months. This is because banks hold all their liabilities, all their deposits, as well as their loans on the balance sheet as fair market. So it's much more a book value of that and how much you have to pay per share. So a price to that book value as far as valuation. And here we do see that shares of JP Morgan trading at 1.55 times on a price to book value. That is right around that five-year average. Whereas we see Bank of America trading for 1.16 times. And again, just right around that 5-year average. That doesn't necessarily mean Bank of America is necessarily cheap here, okay? Because we do see that Bank of America at 1.16 times book value is right around that 5-year average. So I don't want you to think that just because you're getting Bank of America for a cheaper price to book value, that is all of a sudden going to catch up at that 1.5 times price to book value that we see with JP Morgan. Since the 5-year average for Bank of America is right around that 1.16, 1.18, then it's probably going to stay there, and your return is just going to be the return on the increase in book value over time. So whereas normally when you're looking at valuations, when you're comparing stocks, you're thinking, okay, is this lower valuation stock, is it low enough to make me overlook some of the strengths and advantages in the higher valuation stock, the stock that is relatively more expensive, and will they converge eventually to give me a little bit higher return in the lower value stock? Now, in this case, with that 5-year average of Bank of America being right around the same price to book, it doesn't appear that they're ever going to close that valuation gap, and unless there is something drastically different that happens with these two banks or the two business models. It looks like Bank of America is just always going to have that lower valuation. JP Morgan deserves that 1.5 times price to book value, and it's going to have the better growth, so it's going to stay out in front and probably give you a better return. I think JP Morgan is undeniably the better run bank and deserves that premium. I also like those larger loan loss reserves that we talked about, though it's only a marginal impact in the near term. I am watching the consumer business to see that doesn't weigh on the core business of JP Morgan, but I got to give the edge to JP Morgan here. We've still got 2 more matchups to find the best investments, including those dividend stocks, Realty Income and Simon Property Group. But up to now in the series, I've really talked through how to look at the numbers to find those best stocks to buy. Now, I want to finish this up with something even more important, understanding how these numbers point out the very best of breed stocks. You'll remember in those first 2 videos, I walked you through looking at that revenue growth and the profitability, really comparing companies based on how fast they can grow sales and how well they turn those sales into profits. And then we looked at the importance of comparing each company, not just against itself and not just randomly against another one, but against its direct competitors to find the ones in the group really leading the pack, the ones with a competitive advantage that are taking market share away from their peers. I'm going to leave links to both of those in the video description below. Make sure you check those out because it's all building up to what I'm going to talk about now. So this all starts to come together, right? You can see why we focused on that sales growth and profitability in our matchups, not just because we're trying to find the companies growing their sales or their earnings faster, but because these can tip us off to those companies with the best of breed advantage. As you're looking for these advantages in these companies, there's primarily 4 places you want to look. First is some kind of product innovation. Has the company changed the product in its industry so that it's better in some way? There's also a distribution or a delivery advantage. Has the company found a way to deliver that product to the customers that's either faster or less expensive than peers? You can also have advantages in cross-selling. This is like where Amazon has its Prime membership that allows it to easily sell customers into all of its products, from media to e-commerce and the cloud. And the 4th potential point of advantage could be from some kind of like a brand strength, right? Loyalty that gives a company pricing power over either its suppliers or its customers. Here, think of how much Apple gets for its iPhones, right? Starting at $500 or $600 or $800 versus a Samsung, which starts at $200. Apple is just able to get 3 times or more for its phones because of that strong brand following it has with its customers. And I know this is much more vague than just comparing the numbers side by side like sales growth or profitability, but this is where the real money in investing is made. finding that company growing its sales faster or the one turning sales into profits more efficiently, a lot of times that's going to be fully reflected in the share price and the valuation already. Like what we saw with JP Morgan, right? The share valuation, that price to book value is so much higher than Bank of America because it does have some of those competitive advantages. Another example here, shares of Tesla trade for 7 times on that price to sales basis versus just 0.36 times for shares of GM because, well, Tesla is growing sales at a 50% pace versus flat or negative growth for GM. Everyone knows that. Everyone can see these numbers. Your job as an investor is to explore the advantages that Tesla might have over GM and then ask yourself, are those advantages long lasting? Are they defensible and strong enough that makes buying the stock even at that higher valuation worth it for the returns? Again, this is probably the hardest but most important part of investing. So if you need to, just go back to the other videos where I'm talking about the different advantages and the trends driving each stock. And that can help give you a feel for what you're looking for here to make sure you're always buying the best investments. Back to our comparisons though here, and Realty Income, ticker O, against SPG, Simon Property Group. Realty Income, of course, the monthly dividend stock with those retail properties, convenience stores, drugstores, pharmacies, against Simon Property Group, which is a mall operator. It owns those mall spaces and operates those, leases those out to the retailers. We talked about why we're looking at AFFO, or adjusted funds from operations, in our last video on those real estate investment trusts. Make sure you check that out because it's very important why you're looking at AFFO and FFO instead of revenue, instead of earnings for these real estate investment trusts. But here we see some fairly strong revenue growth, some fairly strong FFO growth for Realty Income on the top there, 4% annualized over the last 3 years, 4.5% over the last 5 years, and increasing to 5.9% over the last year. So it does appear that Realty Income is improving its trajectory, its trend for adjusted funds from operations. Here on the bottom with SPG, while we do see that over the last year, Simon Property Group had a huge year, 25% growth in its adjusted funds from operations. I think the longer term says it all. Over the last 5 years, it has lost funds from operations 4.44%, so almost 0.5% a year, every year of the last 5 years. That is even including before the pandemic, as the economy was doing very well for retailers. We still see that slow death for mall operators and for malls. So while SPG had a great year last year, and you might see the stock go higher, there is one thing that worries me tremendously about this stock, even against some of the other mall operators. So some of the mall operators like Macerich or traditional mall operators, SPG has what is called an operations investment, this Spark Group, this SPARC group, which owns operational investments in Aeropostale, Brooks Brothers, Eddie Bauer, Forever 21, Lucky Brand, Nautica, Reebok. So what this is, SPG actually went in and bought shares of these really bankrupt companies. Most of these were going into bankruptcy or filed bankruptcy. Aeropostale, Forever 21, Brooks Brothers went into bankruptcy. SPG went and bailed them out with a cash injection just to make sure that the stores weren't closing down and were going to create vacancy in their malls. They did this with JCPenney as well. They bought a controlling stake in JCPenney, acquired it out of bankruptcy, paid money. So now it is not only in the business of running these malls, but it's trying to be in the business of in these retailers as well. It's trying to be a retailer as well as a mall operator. You also see in this graphic what SPG is calling its SPG Ventures. This is more of like a venture capital fund where it invests in very small startup retailers, things like Foursquare, things like Kitchen United, Lifetime, Techhomeby, these companies on the bottom, these very small startup retailer operators. So what worries me is that Simon Property Group is now losing its focus from being just a core real estate investment trust, just owning those malls, operating those mall properties, passing those cash flows on to investors, but now it's also trying to be a retailer, okay? It's bought shares, controlling interests in these bankrupt retailers. It's trying to turn these around just so it doesn't have vacancy in its malls. We'll come back to that later, but with these high yield dividend stocks or with these real estate investment trusts, you also want to look at the payout ratio. How much of the funds from operations, how much of the cash flows or the earnings is going to pay the dividends? That's a huge sign for dividend sustainability. It's a huge sign for whether the dividend can be increased. Here we see that SPG is paying the lower payout ratio. Just 60% of its adjusted funds from operations is going to pay that dividend. It also has the higher AFFO yield, which is a strong sign for the dividend. It can always increase that that payout ratio a little bit, maybe grow the dividend, or even if those funds from operations fall a little bit, it shouldn't have any problem with its dividend payments. Here with Realty Income, something I pointed out in our prior video, I do worry about it for dividend growth. The way its leases are set up, it's only set up to return maybe a 6 or a 7% annual return on those leases. That's right around where the dividend yield is right now. It's already paying 76% of its adjusted funds from operations. So that core cash flow metric, it's already paying 76% of that to satisfy the dividend. That's not leaving a whole lot of room for growth or dividend growth. Here on the valuation side is where your head just wants to explode, right? Because on the top here with Realty Income, you have a price to adjusted funds from operations over the last 12 months. You've got a price of 17.65 times that adjusted funds from operations. That's just above the sector median at 16.78 times. So here we do see that Realty Income is relatively expensive to other REITs in the sector, trading at 17.6 times. It is relatively expensive here. And then when you look at Simon Property Group, trading for just 11.3 times on that price to adjusted funds from operation ratio, so selling at a steep discount. So again, your job as an investor is to understand, okay, I know all these things are going wrong with Simon Property Group, the slow death of the malls, slow death of retail versus e-commerce, but is this stock just too cheap to ignore? Is this huge discount here, 11.3 times on a price to adjusted funds from operations, that 32% discount to the sector median? Is that enough to make me overlook some of these and think that, if the consumer can stick with it, and if bricks and mortar stores or retail stores and malls can come back just a little bit, might I make a very good return in this SPG, at least in the near term? And here, if consumer spending does improve, this SPG might be a great investment, might provide a very high return, especially with some of these venture plays as these companies come back, if that consumer spending can bail them out. For a pure play REIT though, I've got to give the win to Realty Income here. If I'm investing in a real estate investment trust, I want a company that is investing in real estate, that is running real estate, not one that's trying to get mixed up with being a retailer and bailing a lot of these companies out. SPG is just moving too far away from that focus and could die that slow death along with retail, right? As e-commerce eats more and more into brick and mortar retailers, more and more into the mall. I think SPG is going to find that a lot of these investments it made into these bankrupt companies like Forever 21, Aeropostale, JCPenney is just going to bog them down even more than what they would have had if they would have just let them go bankrupt, fill that vacant space in their malls, and just be a mall operator like they should be. Now, with Realty Income, although it is focused on that retail space, it is much safer from the e-commerce trend, because a lot of these are pharmacies, drugstores, convenience stores, gas stations, things that you're going to have to go to even if you're buying everything else online. Coming up, we've still got our stock comparison of Ford versus GM, both of them reporting huge earnings announcements this week. But click through to our first video for Tesla, how it stacks up against these legacy automakers and against Amazon. This is the big one, right? Ford Motors, ticker F, versus General Motors, ticker GM. Now, what you got to understand is U.S. light vehicle sales were down 8% last year, and really the worst here since 2011. So all the automakers have sold off on those higher rates and higher prices. 2023 could still bring back a low single-digit growth, but we might have to wait till 2024 for real growth in these. I think there's a lot of reason why to go in here and buy these at these bargain basement prices, though, because as that growth returns, not only in electric vehicles, in traditional combustion engines, as well as self-driving, I think you see a lot of growth in these stocks. Here in the revenue growth for the two companies is very much similar growth in the revenue last year. Both have above sector median growth, both negative annualized sales growth over the last 5 years. So both of these seen negative sales growth on an annualized basis over the last 5 years. Very tough environment for the automakers, but with Ford outperforming by about 1% this year. Now, this EBITDA number that we're looking at Ford is skewed a little bit. It's reported here at 69% earnings growth over the last year. That is skewed because of the $9 billion in investment income in 2021 on its sale of Rivian. So if it hadn't been for that, if it hadn't been skewed by that $9 billion, EBITDA would have been closer to about 27% for the prior year. That is still right around the 5-year average for Ford at about 28%. Of course, this just proves you always need to double check your numbers you see on any website and just ask yourself what's actually normal, repeatable business for a company. Now, that earnings before interest, taxes, and depreciation, that did grow by 69% for Ford, but it wasn't something that they can do every year. Every year, they're not going to be able to sell a segment segment out of their company for $9 billion. So you got to adjust these numbers sometimes for what's repeatable, what's recurring in the business to give you a fair comparison against peers. If you're looking at profitability, I was surprised that it is GM's party, right? Both have improved their 5-year average. And again, this is something I'm looking for whenever I look at a company. I want to see that trend to higher profitability. If we look at the 5-year averages for each of these, whether in gross profit, EBITDA margin, that core profitability metric, we can see that the 5-year average is lower. The current trailing 12 months profitability is higher. That means both of these companies are getting more efficient at turning those sales into profits. But we do see here with General Motors on the bottom that it has outperformed Ford on every profitability metric and in both time periods, on the 5-year average as well as the trailing 12 months, the last 12 months. It has outperformed Ford by about 1% or 2 on every metric. Of course, both Ford and General Motors reported earnings this week with widely different results, actually. GM beat its sales and earnings estimates, sending the stock higher by as much as 8% on that day. Ford, on the other hand, was able to beat its revenue expectations, but missed on earnings and missed on about 100,000 vehicle units of sales expected, which equated to about $1 billion in missed earnings. Our shares of Ford are down as much as 6% in the pre-market as I'm recording this, so there does seem to be some kind of short-term execution issue, some operational problems at Ford, while GM appears to be firing on all cylinders. So everything else aside, I think GM is probably the stronger stock in the near term, probably sees some of that momentum carry it through. Ford might lag a little bit, but I think this is where you need to separate the outlook for each of these and ask which has the stronger future growth, which is after we get through this near terms, maybe fix some of these operational issues at Ford. And this is actually very interesting case because it appears that Ford and GM are staking their futures on 2 entirely different paths. For Ford, it's driving hard into those electric vehicles. The Lightning F-150 saw 15,000 deliveries last year, about 2.4% of its total F-Series deliveries. So far in 2023, Ford has booked 2,200 sales of its Lightning F-150 and 2,600 Mustang Mach-E sales. That's just last month alone. And this is after cutting the price about 10% recently to compete with Tesla's recent price cut. Along with that $7,500 credit from the Inflation Reduction Act, Ford EV buyers are now getting about $10,000 discount, which is going to significantly lower these prices and make them competitive. Now, for its part, GM has had battery production issues and said it won't be able to ramp up production of its EV Hummer until the second half of the year at the earliest. The company sold just 854 vehicles last year, so very much behind Ford and Tesla in that EV transition. On the other hand, General Motors seems to be betting its future on its self-driving Cruise robotaxi, aiming to launch a service later this year. Now, I doubt we see this anywhere this year, considering it's literally run into troubles in its San Francisco test market, but a select rollout next year and nationwide by 2025 is possible. So again, this is really interesting because while both GM and Ford have dabbled in both areas, right, EV and self-driving, each are clearly focused on one at the expense of the other, and that's going to mean a big difference in the growth over the next few years. A revenue growth for self-driving and those robotaxi service is going to be huge, no doubt, but I think it's further out than that potential growth in the market share for EV right now. Okay, we are already seeing much faster growth for EV. We're not even seeing anything for the self-driving or robotaxis yet, or likely for the next few years. So that's why I think Ford clearly has the advantage with the two in growth. Coming back to valuation, here we see something very similar to what we saw with Realty Income and SPG, where one company is trading at a significant discount on that valuation. Here we see shares of General Motors, GM, trade for just 5.5 times on that price to earnings basis, which is a discount of 32% to that 8.2 times valuation that you'd pay for shares of Ford. So for shares of Ford, you're paying $8.20 for every $1 of earnings that the company generates. That is 32% more than what you pay for every dollar of earnings generated by GM, so it's relatively more expensive. And what's more, Ford's shares are trading a little more expensively compared to their longer-term 5-year average. In fact, about a 10% more expensive, while shares of GM are at a slight discount to the average. Again, as an investor, you have to ask yourself here, with everything that you've seen on sales growth, profitability, any kind of a competitive advantage like I believe Ford has with EVs over the next 3 to 5 years, is it worth paying a little bit more for these shares? Or our General Motors shares are so attractively priced that you can overlook some of that potential weakness in sales going forward if it does fail to get into that EV market share. Again here, I'm just willing to pay more for a stock or a company that I think has a clear advantage over its peers. While Ford might not have the start in electric vehicles that Tesla has, it is clearly dominating over GM in that space. And I think that's where the growth is. The electric vehicles is where the growth is going to be coming for car makers in the next decade. And for GM to lag here, to slow roll its production of electric vehicles, I think it's going to be a drag on the shares. And I have to give the edge to Ford for that potential growth. Now, yes, GM will eventually benefit from the self-driving unit and eventually even into electric vehicles, and it appears lately it's operating at a higher level. So maybe Ford shares lag here for the next few months while GM kind of outperforms, but I still think in the long term, so we're talking 3 to 5 year scenario, Ford's focus on electric vehicles is going to pay off for that stronger growth and returns. Let me know in the comments which stock you want to see compared next, or click on the video to the right to see how I'd invest $1,000 right now. 3 different portfolios for 3 different goals. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.